Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip looks at U.S. Treasury yields. How low can they go? The yield on the U.S. 2-year Treasury is trading below the federal funds rate, which is 1.5%, and that rate will likely to be cut to 1% following the end of next week's 2-day FOMC meeting on October 29. Yields on the 5s, 10s, and 30s are below 2.5%, 3.5%, and 4% respectively. My mortgage mulligan plan would give homeowners mortgage rates of 2.5% for a 2-year adjustable, 3.5% for a 5-year adjustable, and 4.5% for a 30-year fixed-rate mortgage. Instead, the 30-year fixed-rate mortgage is around 6%. Our regulators insist on continuing to allow Fannie Mae and Freddie Mac to issue debentures, and these rates are 139 basis points wider on the 2-year, 123 wider on 5s, 98 wider on 10s, and 94 wider on 30s. Wider spreads since conservatorship just proves this policy failure. The U.S. Treasury pronounced that Fannie and Freddie debt was U.S.-backed, and the market simply does not believe it. Let's nationalize the GSE and just borrow more through increased Treasury issuance. Stop wasting taxpayers' money. My second blip looks at falling gold and crude oil prices and the stronger dollar. I must admit that I thought gold would be moving higher as currency of last resort, but it seems like the greenback has assumed that role. The weekly chart for gold shows the downtrend and weakness is approaching the 200-week simple moving average at 651. I was correct on crude oil with the call $75 before 200. What I believe is happening is commodity liquidations by pension funds. They don't want to own stocks, so they pile into U.S. Treasuries. The monthly chart for crude oil shows that when a parabolic bubble bursts, you just don't know how hard the market can fall. The 120-month simple moving average is $46.47. Look at the weekly chart for the euro, a double top at 160. When the 200-week simple moving average at 1.337 failed to hold, the stronger dollar took center stage. My third blip looks at the weekly and monthly charts for the Dow with Richard Suttmeyer's bear tracks. The Dow clearly illustrates the importance of tracking long-term moving averages when markets are in secular trend changes. The Dow is ending a 26-year bull market and entering a multi-year bear market. The weekly chart shows the Dow has been below its 200-week simple moving average since June. The monthly chart shows the first break below the 120-month simple moving average since July 1982. The crash of 87 was a bull market correction. Now we are in a multi-year bear market. My fourth blip looks at the housing market index and regional banking index. The weekly chart for the residential housing sector index, HGX, shows it trading at a new multi-year low. The concern is that builders and developers owe $627 billion to community and regional banks. With the National Association of Home Building Housing Market Index at a record low and housing starts at a crawl, how will these loans be paid off? The weekly chart for the Regional Banking Index, BKX, will be knocking on the door of a new multi-year low probably today. Community and regional banks need to be consolidated as they brace for additional defaults and foreclosures and failed real estate loans, including C&D loans, commercial loans, and home equity loans. PNC is buying National City and will become the 10th TARP bank. I predicted that National City would be a goner, and I predicted PNC would be anointed as a TARP bank. I did not predict this combo, but it makes sense and prevents the stigma of another bank failure. Look for more of these deals in the weeks ahead. That's today's 4 in 4. Enjoy your weekend, and go Rays!